Every collapse in history had a warning. Not in headlines, not in speeches, not in official forecasts. In gold. Long before banks admitted stress. Long before governments changed policy. Long before markets panicked publicly. Gold moved. Not dramatically at first. Not in a way that made evening news. But quietly, persistently, it shifted. And almost every time, institutions either ignored it, downplayed it, or actively reframed it. Now here's the uncomfortable question. Was gold predicting collapse? Or were banks burying the signal because it exposed something they couldn't afford to admit? Because gold is not just a metal, it is a mirror. And when that mirror reflects rising distrust in currency, debt, or policy, it makes institutions uncomfortable. Let's strip this down logically. Gold has no yield. It does not grow earnings. It does not innovate. In stable, high-confidence environments, gold underperforms productive assets. When real interest rates are positive and financial systems function smoothly, gold is boring. So when gold begins rising strongly in real terms, not just a nominal price, but relative to bonds, relative to currency strength, something structural is happening. People are choosing to hold value outside the system. That choice is not emotional. It's informational. Now think historically. Before the Great Depression, the late 1920s were defined by exuberance. Stocks surged, credit expanded, optimism dominated headlines. But beneath the surface, gold flows were shifting between countries. Central banks were adjusting reserves. Strains in the gold standard were emerging as capital moved unevenly. The public saw stock tickers. Institutions saw gold drains. Gold was signaling imbalance in the monetary structure. But banks and policymakers were invested in maintaining confidence, so the signal was muted, rationalized, or delayed. Then 1929 arrived. Fast forward to the late 1960s. The United States was running persistent deficits. Dollars were flowing overseas. Under the Bretton Woods system, foreign governments could convert dollars into gold at $35 per ounce. As inflation pressures mounted and trust weakened, central banks began redeeming dollars for gold. Gold wasn't just rising in price, it was leaving the vaults. That was the signal. But official messaging emphasized strength, stability, leadership. The pressure built quietly until 1971, when convertibility was suspended. The dollar detached from gold. The system shifted overnight. Again, gold didn't cause the collapse, it reflected it. Let's move to 2008. Before Lehman Brothers fell, before the global financial system seized, gold had already begun rising steadily from the early 2000s. It climbed through housing euphoria, through expanding credit derivatives, through low interest rate policy. Gold was not reacting to a single event, it was reacting to structural leverage. Banks framed the rise as commodity speculation, as inflation hedging, as emerging market demand. Few framed it as a loss of confidence in the architecture of debt. Then subprime cracked. Interbank lending froze. Central banks intervened aggressively. During the initial panic, gold dipped briefly. Liquidity was king. But once the scale of intervention became clear, gold surged again. Not because inflation exploded immediately, but because the response revealed fragility. The pattern is consistent. Gold rises in phases before collapse. Not explosively, not in isolation, but persistently, in real terms, against other assets, and institutions rarely acknowledge it as a systemic warning. Why? Because gold's rise undermines narratives of control. Modern banking is built on confidence, confidence in currency stability, confidence in debt repayment, confidence in central bank credibility. When gold climbs despite official reassurance, it signals that some capital is opting out. Opting out is contagious. So instead of acknowledging gold as a barometer of distrust, it is reframed. It's called speculative. It's called irrational. It's described as a relic. But here's the logical structure. Gold competes with sovereign bonds. If real yields are attractive, gold weakens. If real yields fall below inflation expectations, gold strengthens. Before most collapses, real yields compress. Debt expands. Policy becomes reactive. Risk builds invisibly. Gold senses this compression. Before 2020's pandemic shock, gold was already trending higher. Not dramatically, but steadily. Trade tensions were rising. Global debt had reached record highs. Real interest rates were thin. When liquidity froze in March 2020, gold fell briefly. Again, liquidity dominated. But as central banks unleashed massive balance sheet expansions, gold surged to new highs. Was gold predicting a virus? No. It was reflecting fragility, and fragility precedes catalysts. The signal gold sends is not about specific events. It's about structural imbalance. Rising gold often indicates three things. First, declining confidence in long-term purchasing power of currency. Second, compression in real yields. Third, growing systemic leverage or geopolitical tension. Banks, by design, resist broadcasting these signals. If they acknowledged openly that gold's rise reflected distrust in policy, they would accelerate the very behavior they want to avoid. So instead, gold's movement is contextualized narrowly. It's inflation hedging, it's jewelry demand, it's ETF flows. Rarely is it framed as systemic stress. Let's step back from examples and focus on pattern. Before collapse, three conditions often appear. Credit expansion outpaces productivity. Real interest rates compress or turn negative. Policy confidence becomes fragile. Gold thrives in this environment, not because gold predicts collapse magically, but because it measures confidence indirectly. When institutions say everything is stable, but gold quietly climbs against currency and bonds, there is a divergence. Divergences matter. Markets often signal stress through spreads, volatility indices, or yield curves. Gold is another spread between trust in fiat systems and desire for hard assets. Now here's the deeper layer. Banks do not need to suppress gold explicitly to bury its signal. They can bury it rhetorically. If media coverage frames gold as outdated, irrelevant, or niche, its rise does not trigger mass behavioral shifts. It becomes background noise. Only when gold spikes dramatically does public attention return. By then, the structural shift is already advanced. This is why gold's most important movements are rarely its most explosive ones. It's the slow accumulation phase that matters. In the years leading to crisis, gold often grinds higher quietly while equities soar. That divergence tells you some capital is hedging systemic risk, even while public optimism dominates. It happened before 2008. It happened before the breakdown of Bretton Woods. It happened before emerging market debt crises. The public saw growth. Gold saw stress. But we must remain logical. Gold is not perfect. There are periods when gold rises without immediate collapse. There are false signals. There are years of underperformance. However, when gold rises alongside declining real yields and expanding fiscal deficits, the pattern becomes stronger. It's not one indicator. It's convergence. So were banks burying gold's signal? Not necessarily through overt manipulation, but through narrative management, confidence management. Modern financial systems depend on belief. If belief fractures, velocity accelerates. Capital moves faster than policymakers can respond. So institutions frame gold's rise as noise, not signal, and often the public agrees until the catalyst arrives. Here's the philosophical layer. Systems protect themselves first, not because of malice, but because stability depends on it. If acknowledging gold's rise as systemic distrust would trigger bank runs or capital flight, institutions will avoid that framing. They emphasize resilience. They highlight tools. They reassure. Gold quietly accumulates. Then a trigger hits. A banking failure, a currency devaluation, a liquidity freeze, a geopolitical rupture. And suddenly gold is no longer background noise. It becomes headline. By that point, it is no longer an early signal. It is confirmation. The lesson is not that gold causes collapse. It's that gold reflects pressure before collapse becomes visible. It reflects pressure in a system built on leverage and trust. And leverage plus eroding trust is the formula that precedes most financial breakdowns. Now consider today. Global debt levels are historically high. Real yields fluctuate around tight margins. Geopolitical fragmentation is rising. Central banks diversify reserves quietly. Gold has been accumulating in central bank vaults at one of the fastest paces in decades. Is that random, or is it structural hedging? When institutions themselves accumulate gold while publicly downplaying its importance, that divergence should be noticed. It does not mean collapse is imminent, but it means risk is being acknowledged internally. And here's where pure logic matters. Gold rising does not guarantee collapse. But collapse rarely occurs without gold rising first. It is a necessary but not sufficient signal. The real intelligence lies in watching alignment. If gold rises while credit spreads widen, If real yields compress, if fiscal deficits expand, and if geopolitical tensions escalate, the pattern strengthens. If gold rises alone while real yields are strong and debt is stable, the signal weakens. It is context that determines meaning. So did banks bury gold's real signal before every collapse? They didn't need to bury it physically. They buried it narratively. By treating it as peripheral, by avoiding its interpretation as distrust, by managing confidence until confidence managed itself. And that may be the final uncomfortable truth. Financial systems are not built to reveal their own fragility early. They are built to absorb doubt until they cannot. Gold is one of the few assets that responds to doubt without permission. It doesn't need earnings reports. It doesn't need policy approval. It simply reflects shifting belief. And belief shifts quietly before it breaks loudly. So if there's one philosophical conclusion here, it is this. The signal is rarely hidden. It is ignored, because acknowledging it would require confronting the limits of control. Gold does not predict collapse mystically. It measures the erosion of confidence logically. And confidence, once eroded past a certain threshold, rarely returns in the same form. Watching gold is not about fear. It is about understanding that systems built on trust leave footprints when that trust begins to thin. The question is not whether banks buried the signal. The question is whether we chose not to see it.